company reports, they're just full of numbers, jargon, and these huge pronouncements, right? But how do you actually cut through all that noise to figure out what's really going on with a business? Well, today we're going to demystify the language of business so you can start reading between the lines. Okay, let's start with this. Back in 2010, Steve Jobs and Apple put out this statement. I mean, on the surface, it sounds absolutely incredible, doesn't it? Revenue's up, profits way up. It's the kind of headline that makes investors' eyes light up. But here's the thing. Announcements like this are really just the cover of the book. And that is the million-dollar question. Sure, the numbers look great, but is the company actually building a stable, long-term foundation, or is this just a one-time sugar rush? To answer that, you have to look past the flashy headlines and learn to speak the language of financial analysis. And that is exactly what we're going to do right now. So, why do companies even put out all these reports in the first place? Well, the whole point of financial reporting is to give people, investors, creditors, even you, the information you need to make smart economic decisions. The goal is to turn a mountain of data into something you can actually use. This is where financial analysis comes into play. It's the process of grabbing those reports and really digging in to evaluate a company's past, its present, and even its potential future. It's all about finding the story that's hidden inside the numbers. Okay, so how do we see what's going on inside a company? Well, we use a set of tools that kind of act like a financial X-ray. These are the 3 key financial statements that every single analyst starts with. Let's break them down. First up is the balance sheet. The best way to think about it is like a photograph. It captures a company's entire financial position on one specific day. On one side, you have assets. That's all the stuff the company owns. On the other side, you have liabilities. That's everything it owes to others. And the difference between the two, that's equity. It's basically the owner's stake in the company. And here's the magic rule. Assets always have to equal liabilities plus equity. It always has to balance. Now, let's put some real numbers to that idea so it's not so abstract. This is a simplified peek at Walmart's balance sheet from back in 2010. You can see they had about $171 billion in assets. They owed about $98 billion, so the remainder, that $73 billion, was the shareholders' equity. See how the liabilities and equity add up to the assets? That's that core equation in action right there. All right, let's move to our next tool, the income statement. If the balance sheet is a photo, the income statement is a movie. It shows you the company's performance over a stretch of time, like a quarter or a whole year. It kicks off with revenue, then it subtracts all the costs and expenses, and what you're left with is the famous bottom line, the net income or profit. And finally, we have the statement of cash flows. Now, this one is absolutely crucial because it answers a very simple, very important question. Where did the actual cash come from and where did it go? It breaks it all down into 3 main buckets. Cash from the day-to-day business, cash used for big investments, and cash from financing, like taking out loans. And this brings us to a huge, huge point. Profit is not the same as cash. A company can look incredibly profitable on paper, but still run out of money and go bankrupt. This example shows it perfectly. Senate Designs posted a profit of 80,000 euros, but look at their cash flow, 230,000 euros. How? Well, they collected a bunch of cash from their customers, but hadn't paid their own suppliers yet. Remember this, profitability is an opinion, but cash is a fact. Okay, so those big 3 statements, they give us the main plot. But the real secrets, the context behind the numbers, that's often buried in the other documents. This is where the real detective work begins. You have to look beyond the main pages. First, you've got the financial notes. That's the fine print, explaining how they came up with the numbers. Then there's the MD&A. This is where the company's leaders get to tell their side of the story, what went right, what went wrong, and what they're worried about. Honestly, it can be the most revealing part of the whole report. And finally, you have the auditor's report, which is like an independent checkup from a third party. Just think of that audit opinion as a report card. If you see an unqualified opinion, that's an A+. It's a clean bill of health. You're good to go. A qualified opinion, that's a yellow light. It means things are mostly okay, but the auditor found something specific they didn't like. But an adverse opinion? Whoa, that's a huge red flag. The auditor is basically screaming, do not rely on these numbers. So, we have the tools, and we know where to find the clues. But how do you put it all together in a structured way that actually makes sense? Well, let's walk through a simple 6-step framework you can use for any financial analysis. Here's your game plan. It all starts with your purpose.
What question are you actually trying to answer? Are you thinking about investing or maybe checking on a competitor? From there, you collect your data and then you process it. This is where you start calculating key numbers and making comparisons. Step 4 is the fun part. You analyze and interpret what it all means. Finally, you communicate your conclusions and, this is key, you follow up, because a company's story is always changing.
Let's make this real. Let's see how this works in the wild. A credit agency, Moody's, had a clear purpose. They needed to rate the financial risk of a company called Tech Resources. They gathered data and noticed something really important. The company was paying down its debt, and fast. And boom, here's the smoking gun from their analysis. The debt-to-equity ratio, which is a key way to measure financial risk, dropped like a stone in just over 6 months. It went from 0.55 all the way down to 0.36. This chart showed a clear, undeniable improvement in the company's financial health. And that analysis led to a very clear conclusion. They upgraded the company's credit rating. The numbers told a story of lower risk. So, from a flashy headline about profits to a deep dive analysis of risk, you can see how these tools and frameworks help you uncover the real story behind a business. The numbers are out there, they're just waiting for someone to interpret them. The only question is, are you ready to read them?